The latest edition of Real Talk, where we are truly going to put the real in real estate tonight, talking with our esteemed partner here, Britt Fair of Fair Texas Title. And Britt, we got a little sensationalizing on our headline for today, which is it's called the Banks Are Failing. And how does that relate to the real estate market?
Well, first of all, we'll be fair and say that not all the banks are failing. There've just been a few. And so anyway, so that's that. Getting that out of the way, it is kind of an interesting time. You know, the news, I guess it was now a week and a half ago, whatever, the weekend before this past one, when Silicon Valley Bank failed, for lack of a better word. There was a run on the bank, and certainly that put some uncertainty into the world of finance in the U.S. and you know, whatever, you know, because everybody touches banks, right? I mean, even if you just have a paycheck that goes into your bank or whatever, you know, it's like that touches everybody.
Nobody is immune to having concerns, especially when obviously, you know, FDIC is only insuring up to $250,000. And so obviously people that have the benefit of having more than that in the bank really had to be introspective and kind of look like, okay, what do we want to do at this time? And then, you know, you and I kind of talked about before that it was what is a little different from this versus 2007. And you had a great point as far as the run on the banks and people panicking and going and doing that. What is the big difference between the two?
Well, a couple points of, okay, so 2007, for those of us who were in the business, I mean, we all had seen the build up to 2007 with a lot of the crazy mortgages that were made and ultimately backfired, and all these banks were holding these really bad mortgage loans. And, you know, so some banks failed, and, you know, the interconnectedness of the banking system, you know, sort of came into view there. But that was sort of a systematic problem of the bad mortgages that had been made and packaged up and, you know, all called AAA by the ratings agencies. I mean, there was a lot of culpability to be passed around as far as why the banks had trouble in 2008. But this is real different. So Silicon Valley Bank is a pretty, I mean, the key here is it was pretty unique. Okay. And that's why, you know, I don't know how many banks are going to fail, and it may be zero more, right? I mean, we may have it all under control, but sort of like, you know, the water on your roof is going to find, you know, work its way down until it finds the weak spot and gets in. Well, that's the same thing with bank panics or whatever. It finds the weak spot. And in this case, the weak spot, the first one anyway, was Silicon Valley Bank.
Sure.
And, you know, the circumstances of Silicon Valley Bank were, well, number one, I think the stat I saw was that 94% of the deposits at Silicon Valley Bank were greater than 250,000. So most banks do not have that profile, right? So if you have
cater to a lot of tech companies,
and absolutely,
and things of that nature.
And so they would get this money from venture capital firms and whatnot. And one of the rules, the venture capital firms and the bank kind of had they all worked it out. They just said, well, we're going to give you the money, but put it in Silicon Valley Bank. So there were a lot of huge deposits in there, not a whole lot of mom and pop. You know, got my checking account there and I got, you know, $5,000 in my checking account or whatever, you know, like it was these huge companies. So, you know, let's call it 90+%. I think the number was 94 of depositors were over the $250,000. And why does that matter? Well, the reason that matters is if you have under $250,000, you don't really need to have a run on the bank, right? I mean, it's like, okay, well, even if this bank is terrible, well, my money is going to be insured by the FDIC up to 250,000. So I don't need to have a run on the bank. Okay. So the fact that they had so much more than normal as far as a depositor percentage that were in excess of the 250,000. Okay. So number two, we had this, they had this big concentration of these venture capital type firms, right? So, let's go back a couple of years to the pandemic. All of a sudden, money was free, basically, super cheap to borrow money. So, and money was flowing to VCs. So the venture capital firms were seeding all these companies. And so basically they just had a ton of cash and were putting it in the banks, right? So times were good. And those companies had a whole lot of cash. Well, when Silicon Valley Bank got all that cash, they had to go put it to work, right? You can't just, they didn't want to just sit on it and earn no return, because that's basically it was hard to get a return on, buying anything conservative. So they bought 10-year treasury notes and maybe some long-term mortgage-backed securities, which generally are considered pretty conservative, but they didn't do a very good job of matching the duration of that money, meaning they locked it up for 10-year bonds, say, and meanwhile, the depositors could take their money out whenever they wanted. Well, so fast forward to the recent days, things haven't been as great for technology firms, and some of these, early stage venture capital seeded firms were starting to burn through capital. Yeah. And so they all of a sudden needed cash in their business rather than having more cash than they could handle. And secondly, they also had alternatives to holding cash in the bank. Even if they weren't burning through cash, you could get 4.5% on a money market, right? So rather than hold it in a bank account that's not earning any interest, some of them wanted to put the money to work. So you had these sudden outflows over the recent months at Silicon Valley Bank, just of the natural occurrence, not any type of bank run, but deposits were flowing out. And so all of a sudden Silicon Valley Bank had an issue. And the issue was that they had the market value of the assets that they had bought, the treasury bonds and whatever that they had bought, was no longer worth what they had paid for it, because in a rising interest rate environment, the market value of your bonds goes down. And so there was this equity cushion, or basically the what's the right term, but the cushion of cash that they had in the net worth of the bank. Think of it as the net worth of the bank. Yeah. Basically shrunk to where it became negative, right? Because all of a sudden they lost 20 to 25% of the value on their bond holdings. And normally they could say, all right, well, we'll just ride it out. Well, kind of that's when the bank run started, right? People started saying, wait a minute, do they have enough money? They've probably taken a bad, bunch of losses on these bonds. And in the meantime, everybody's taking their money out. So there's this thought of maybe there's going to be a problem. And then the whispers started, and it was, the venture capital firms, and there were some names associated with it, which I won't individual people mention, but they were saying to their specific firms that they had seeded money to, get your money out of Silicon Valley Bank, So you had all that. So that was the recipe for the bank run. And then I'll bring up one other thing that was that's really neat. I hadn't thought about much. So the only experience I have with bank runs was every Christmas I would watch It's a Wonderful Life, right? And everybody in here probably knows what I'm talking about. So there's this bank run at Mr. Potter's bank. Everybody's going to make a run on the bank, okay? And the scene, and you can imagine this is kind of how it always has happened in the Depression era or whatever. But people would run up to the bank and want to bang on the doors, and maybe they'd stand in line and they want to deposit all their.
Physically in person.
Physically. Yeah. And so up to recent days, that's what bank runs looked like: is people standing in line to withdraw their money. And what's interesting, and I hadn't really thought about this more, but like the way technology has changed, the way a bank run happens is with one of these, right? You say, oh my gosh, there's whatever bank I'm in is in trouble. I need to move my money out. And so you get on your phone and you can start sending money out that way. So in Mr. Potter's day, and It's a Wonderful Life, the bank would at least have a little bit of time. While people stood in line, you could only serve one customer per teller or whatever. And so they could do stuff in the background and sell bonds or raise equity or whatever. Whereas this thing hit so fast because everybody could try to move money out all at the same time. So voila, that's a bank run circa 2023.
Well, and the other part of that is the rate of disseminating information. and just
absolutely Twitter.
I mean, within 5 minutes, the virality of something of that nature takes a stronghold. And I think that's the biggest thing is the rate in which you can, transfer your money out and the rate of the information traveling was at light speed. And that's also what two big differences were in the 2007, 2008. It took a lot more time, and it took time because our social media channels were not what they are today. Right. So that's where it is really, really interesting. And all of this directly correlates though with the Fed hikes. And I think that's the things that we've been talking about is how do the Fed hikes of their interest rates, what does that look like in correlation to mortgage rates? But this is what's directly impacting. And I know we're a day early and we were hoping it would be, well, I wasn't hoping it would be tomorrow because that would be a very different show.
Yeah.
But what's happening tomorrow, Britt?
Well, the Federal Open Market Committee of the Fed meets every, I think it's 6 weeks. Yeah. And they have their meetings and they decide what they're going to do about the Fed funds rate as it relates to inflation and employment and all these kinds of things. And so that just happens to be, it's a 2-day meeting. It's always Tuesday, Wednesday. And at 1 p.m. Central Time, they come out with their announcement of whatever they're going to do with the Fed funds rate. And then they have a little press conference where they, talk in cryptic language. Right. And what's interesting about it is that, so they've been on this Fed funds rate hiking spree just over the last year, I guess. But, and the thought was that, let's say 2 weeks ago, before all the Silicon Valley Bank stuff, it was pretty certain, I think, or at least common belief that the Fed was very concerned about inflation remaining, too hot. Right. And so that they were going to raise the Fed funds rate by 0.5%, 50 basis points. And then we had the Silicon Valley Bank and Signature Bank. And then this past weekend, we had the Credit Suisse and the mess with, not that that's an American bank, but it's kind of a similar situation. So the uncertainty of the banking system as a whole now has a lot of people second guessing what the Fed is going to do tomorrow. And so, there's some people who are saying, Goldman Sachs came out last week, I believe, and said, we think that they're going to not do anything. They're going to have not unchanged on the Fed funds rate. And, versus a significant majority of people thought 0.5%, 50 basis points 2 weeks ago. So I think now a lot of people are kind of saying, we're going to split the difference.
Meet in the middle.
Yeah, we're going to say that, okay, the Fed doesn't want to look like they're giving up on fighting inflation. So they're going to raise it by 25 basis points. But we don't think they're going to go the full 50 basis points just because I think they're afraid of breaking more banks with, who have invested in bonds and whatever. And so they don't want to, they're just trying to, kind of find what the happy medium is because they don't want to cause more problems in the banking sector, but they also need to project that they still care about the inflation because inflation remains, at 6% on the CPI and 5.5% on the core measure, which is what they really focus on. And the core measure really isn't improving very much. Yeah. So they can either be worried, if they say, oh, we're worried about the banks, we're not going to do anything, then we might be stuck with this impression that inflation is going to be around for a while. So
this sounds like a really toxic hamster wheel, and it's a very fun one.
Well, I hate to say it, but we've had it too good for too long as far as this Fed. I really do have a beef with kind of how accommodating the Fed has been off and on for 15 years. But specifically in 2021, when inflation started rearing its ugly head, the Fed made the strategic decision to do absolutely nothing. Like that was their stated strategy was we're going to absolutely do nothing because this is all going to go away. It's just transitory, which, is a fancy way, I guess, of saying temporary. Yeah. And then they didn't. And so they waited a year too long and were very accommodative and kept a zero interest rate policy, which is just, anyway. So they're trying to correct for things. And again, our government, our federal government and its response to COVID with all the stimuli that were done and the various bills that have been passed. I mean, again, there's a lot of culpability here, but the Fed certainly seemed to sleep at the switch in 2021. And so they've been trying to play catch up, and, catch up in 2022 led to bank issues today.
I was about to say, an interesting first quarter of 2023. So we're going to go to a couple of comments. Of course, we have a Sherryism. Hey, Britt, this is great information as usual, but I've got to tell you, the logic and reason as to who, what, when, where, and why is difficult to trust. And just like you just said, I mean, that's them kind of falling asleep at the wheel for a little too long is the difficult part, because it goes, okay, then who are we really trying to protect? Why did we slow play some of this? And it is a little bit disconcerting, but you can't overcorrect so much to where we become that the part of the self-fulfilling prophecy. So,
well, I think, first of all, they don't want to be wrong. I mean, like that, they were wrong, right? And they've actually, to the credit of Chairman Powell and Treasury Secretary Janet Yellen, they both have come out and admitted that they were wrong. I mean, that, I don't know if that makes us feel any better, but I mean, they have said that they're
supposed to be right. That's why you do the job.
I guess the first, what's the first step to recovery is admitting that you've got a problem. Well, so they admitted that they messed up. And so, I mean, there's a lot of sinister thoughts out there about how some of this is planned, and people want more power, and so who knows what the reality is, and it doesn't even really matter what the motivations are. I think they just screwed up in 2021, and now, and really for 14 years before that, by the way, with just so much money pumped into the system and building a $9 trillion balance sheet at the Federal Reserve with this quantitative easing program. So the point is, I've been calling it the hangover, sort of like that's what we're in. You can't party forever, and eventually the party ends in a hangover. And so we're dealing with a hangover.
I don't want the hangover. I never want the hangover.
Well, then you better start drinking again, or doing whatever it was. There you go.
Okay. Talking about today. And so we've got Knight of Faith, and I apologize if I mispronounced your name, but Ed Dowd thinks more banks will fail, and we are simply kicking the fallout further down the road. It is a bailout between continuing to print money and making whole all depositors for millions. Failed banks. How does it not? Oh, my sigh. Yes, oh, my sigh. Kicking the can down the road, what happens then? So can you kind of pick that apart a little bit, Britt, and give us a little bit of a crystal ball analysis?
No, that is exactly it. I mean, again, we're, we don't want to take our medicine. I mean, that's the thing, I mean, hangovers are no fun, and we don't want higher Fed funds rate, because that knocks people out of jobs, and that, and it stinks, but that's kind of the rock and the hard place that we're between. It's like, I don't know what else. So they're going to keep, hiking the Fed funds rate to fight inflation. That's part of the hangover here. And, it's interesting, the question or the comment about kicking the can and other bank failures, I was talking to somebody the other day, and the reality is that our banking system is really just built on faith and trust anyway. Like I don't mean in a bad way. That is what it is. I mean, it's not, we're off the gold standard and have been since 71-ish, 72, somewhere around then. And so, I mean, it's got the full faith and credit of the United States government standing behind it. But now we all kind of laugh at the full faith and credit of the United States government.
I feel real secure right now.
with our $32 trillion national debt, or, publicly held debt, and Social Security and Medicare and all the the reality is that we don't, nobody has this bucket of, I mean, the FDIC or even the federal government doesn't have like this vault where they've got the money to go into the vault and bail out the banks. Like if they had to,
they don't have the Duck McScrooge,
jumping up in the coins and playing in the coins. Yeah. No. So, I mean, the reality, I mean, they could print the money, but then if they do that, then we've got a bigger inflation problem again, so
we're 2020 all over again. So,
I mean, so it's, rather than, I'm not going to sit here and say, woe is me. And, I think the reality is whatever world that you're in, and life deals you lemons, you got to make lemonade. You
Yes.
can't just sit here and complain about getting the lemons. And so I think that's really, sort of, I think the constructive part of today is, okay, here's where we are now. Now, what do we do about it? And we're all in real estate, or most of the people listening and watching or whatever, have a connection to real estate. So, I think we just kind of need to acknowledge where we are. And that doesn't mean, there may be some other banks failing, and there may be, absolutely, these are bailouts, regardless of whether anybody wants to call it a bailout. We're bailing out maybe not the equity owners of banks, but we're certainly bailing out large depositors and influential people who happen to be large depositors. And so anyway, I think we just have to say, okay, that's where we are now. Now, where do we go forward in our careers and our personal, investments in a bank, or, cash in the bank or whatever. So,
well, and that leads us to, Alroy Fernandez asked, thank you guys. How is this going to affect home prices? And I think that's what everybody in our industry is talking about right now. Is what is the direct correlation? Everybody has to have money, and everybody has a different scale of money. I'm glad I have low ends of money in multiple banks personally. So
yeah, there you go. It's the first time we've ever said that, right?
Yeah, move that $100 around in a few different banks, and let's hedge our bets on that side. But I think that's a great segue into how this directly correlates into the real estate market. And I don't think every area in DFW is going to be impervious. And we've already seen stuff sit a little bit longer, some decline in prices, but I also think it's a direct correlation in recalibrating expectations, seller expectations and buyer expectations. And in the last several months, what we've had is, before this obviously banking issue, we had buyers entering the marketplace that weren't your buyers from 2 years ago. They were the ones that said, now's our time to shine, and less risk, and I have more control. And then we have sellers that weren't the same sellers of 2 years ago. And so it was interesting how the two kind of correlated. But now we had a dip in interest rates, and we did talk about this in December. If we saw 5.99, I said it was going to spike again. And it happened, I think, in the end of January. We saw a 5.99, and it was like this rush on housing, which kind of was like a slow match strike to kind of, I think, pushing the market in the right way again. But I want to talk about from the standpoint of, I put a house on the market last Friday evening, right after the Silicon Valley Bank announcement and everything else. And it literally went like this. Here's hoping, what is this going to look like tomorrow? Because it was a $575,000 house in Plano. Not that is anything unconscionable, but you just don't know. We spent 2 months getting the house, market ready, because that was super important to make sure that we had best position in the marketplace. And I'll tell you, in 36 hours, we had 60 showings and 13 offers. And this was the 2 days after the SVB situation. And so for me, I wanted to get nerdy in my way, not in economic forecasting way, but put my really basic spreadsheet down with no formulas, but at least break down the financials of each offer and really understanding where everything's trending. And I will tell you, the majority of the offers were heavy. I had half were cash, half were not. Even the ones that were not cash were putting 20 to 30% down. So they were heavily, putting money into the asset as far as that's concerned. And then terms across the board. And ultimately, we ended up executing an offer $50,000 over ask. But I had 4 offers that were basically in alignment with one another. I just chose the strongest terms, lender and buyer's agent. So the market told me the house was worth $625, when it was all said and done. And I'm still getting multiple calls a day on this house a week later asking if it's going to fall out. We can't find anything else. And so again, that tells me a week has passed and more banking situations have happened, but people want to convert their money into hard assets. And so that's something that I think we all have to look at.
I think the issue right now, I think traditionally when we talk about real estate and what the prices are going and all that kind of stuff, for whatever reason, I think historically we've always thought first about buyers. Yep. What can buyers afford? Are the job prospects good? what are interest rates that they're going to have to pay, and all those things are real and and important. But that today isn't what is most important. Today is the fact that we just don't have any product for sale.
Yes.
Like we have such a limited supply of inventory that the seller psychology is really more important right now than anything else because it's driving it, right? I mean, you have a couple months, depending on the submarket you're in. I mean, some places it's still sub 2 months of inventory, but I mean, even market wise, it's probably 3.
Yeah.
So really just, and so that's for those who don't really follow that. That's certainly a seller's market. Until you get closer to 6 months of inventory, that's when it really becomes a balanced market. But if you're below that and well below that, like 2 or 3 months of inventory, it's definitely a seller's market. So, so the question that we were addressing is pricing, right? And what happens to home prices. So you have all these factors that some push, pricing pressure up and some are pricing pressure down, and they all kind of intermingle. So let's break through those a few times. So clearly the Fed is trying to fight inflation, right? I mean, that's what they've been doing with the Fed funds rate. So if they are continue to show aggressive against inflation, and do 25 basis points or 50 basis points tomorrow to show that we're still here to fight inflation, a couple things happen that are basically positive for driving down mortgage rates. So mortgage rates generally are going to follow the long-term inflation. So if the thought is that the Fed is aggressive against inflation, then that generally drives mortgage rates down. Even if they're raising the Fed funds rate up today, that drives long-term, your 10, 15, and 30-year mortgage rates down. And then secondly, and I hate to say this, but, I do think that what the Fed is doing is they're trying to slow the economy down, which, in layman's terms means they're going to knock a lot of people out of their jobs. Like they're going to create unemployment. That's really how you slow down an economy, right? You knock people out of their jobs. You stop companies from expanding, because borrowing becomes too expensive or whatever. And then if people are out of work, they don't spend as much money because they don't have as much money. They skimp and save and try to put food on the table and pay their rent or whatever, or their mortgage. But that's what's going to happen, right? I mean, they're going to slow the economy down, whether we talk about whether it's technically a recession or not, but I mean, it's going to slow the economy down. And so your buyers are going to be, they're going to have improved mortgage rates, by the end of the year, say, but a lot of them are going to be out of work. Or, a good number, I mean, I don't know. I don't mean good, but you know what I mean? Well, there are going to be people out of work. So you have all these weird factors that are going in on the buyer side.
Well, and I think that's the other thing too, is in regards to pricing and what that looks like. What we have to do is get back to educating our clients, both on the buyer side and on the seller side. And what we can do as real estate professionals is really ingrain from learning about things going on through a real talk or going to a seminar or a forecast or anything else like that, is bring data, bring information back to your clients. Because the thing that we keep on seeing over and over again is market ready, staged, well-appointed, well-priced product is still going to rise to the top. And so from the seller's perspective, if you're a listing agent, you're going to talk to them, then they're hesitant about spending money because they're concerned about the economy or anything else. That is a temporary situation. There are a lot of affiliate partners out there, if any type of improvements need to be made to the home, that are willing to carry that balance to closing. And of course, we have a title company here, representative, that we can sit there and hold that, and title can turn around and pay those vendor contracts off and things like that. So make sure you line yourself with good affiliate partners that are willing to help you put that flooring in, do the painting, maybe do the roof improvements or something else that needs to be done on the property so that it's not distressed and that it's brought up to at least a respectable condition from the cosmetic side. Because that's what I keep on hearing is buyers have decreased buying power. They're spending more in interest, which means they have less money on improvements. And that's where we can, on that side, be better stewards of our sellers' money and have them put a little bit up front. And the return on that is going to be fantastic. So educating yourselves there, but then on the buyer side too, There was another one. I hate to keep on pointing out Plano, but Collin County is the epicenter, it seems like, of growth in North Texas, and definitely in the whole US as well. But somebody had posted that there was and it was an estate property. It was clean, nothing crazy. It was probably 1,200 square feet in Plano. And it listed for 280,000, and they had 177 showings and 60 offers over the weekend.
That's crazy. Well, so if my scenario plays out, so like when I hear stories like that, I shake my head, because that's the reality. That's where we are on the supply. But if we do have a slowdown in the economy, okay, two things are going to happen that are going to increase the supply of homes, which is sort of negative, I guess, for pricing, right? Because all of a sudden the scarcity thing goes away. Right. But two things are going to happen. So number one, mortgage rates coming down because of a recession or whatever economic slowdown, whatever happens. I think it will be a recession, by the way. But so number one, if rates come down to something, let's just say 5 to 5.5. I don't know what it's going to be, but like all of a sudden there's a bunch of sellers who are potential sellers out there who are not sellers today. And the reason they're not sellers today is because they have a mortgage that says 3%, and they're sitting here loving on it, right?
It's so nice.
Yes,
I love you.
And they love that 3% mortgage, right?
Yeah.
And they say, I kind of want to move. I need a bigger house, or I need a smaller house, or I need a house that's closer to my new job, or whatever it is.
But I'm not going
to give up the 3% mortgage. So, but and especially if they're trading for a 7, right? Yeah. But if they're trading for a 5 or a 5.5 or somewhere in there, they might go, I've been wanting to move, and I can live with that. So, so there will be some supply that comes on because people are finally willing to give up that 3% mortgage for something that they consider more reasonable. Yeah. And then, the other unfortunate thing is, if I'm correct about my thoughts on the economy, is, there are going to be people who are laid off and whatever. And that oftentimes leads to forced sales. And I don't mean foreclosures necessarily. A lot of people who lose their job, they might still have good equity in their house.
They absolutely have good equity in their house.
I mean, if they've owned it for more than a year.
Yes.
But so they might say, oh my gosh, I'm having a hard time paying for this. I need to downsize, or I need to have something less fancy and less expensive. And, I need to sell my house and raise some cash or whatever. So there will be some additional supply that way too, when the economy slows down. And so I think that, until then, for the next 6 months or so, we're going to remain supply constrained, but, somewhere later this year or so, those two factors are going to come into play. And I think supply will start to expand a little bit.
But and supply is going to expand, which means people have options, and that's exciting because everybody then gets a little bit of control and gets choices, and I think that's healthy and good for everyone. The difference, though, of our market into look, Britt, Britt is the man. I mean, how often does that happen in print? Thank you, Chandler Crouch.
Oh, so, yeah. Thanks, Chandler. Chandler's the man. That's right.
Yes.
Okay.
There you go. And here's the deal on that, though, is looking at net migration. And I think that's the biggest thing too, is when you live here locally, you're looking through a much smaller lens. And Sherry just said she's not going that far. Of course.
I saw that, Sherry.
No. So, from the net migration standpoint, and that was the other thing, going back to my spreadsheet, people, obviously agents calling and different things, we're not supposed to look at letters and all those things, but agents will still articulate, hey, I've got a relocation buyer or doing something else. I will tell you, over half of my offers were people relocating, and never one from one area. It was all over the country. And so that was also very interesting, is, the relocation aspect is not going to slow down, especially if we're in a recession and with jobs loss. Then those people from other areas of the country that are not as fortunate as we are to have jobs and businesses available to rehire, they're going to be coming here. And so we're going to have more supply, but we're going to need it, because we are number 2 behind Florida. And I think 1 and 2, between that is very small delta. But like you said, I think number 3 is so far. It's just the two of us.
Now the growth is coming to those places, and it's coming from the places that everybody likes to kick around, the California, New York, Illinois,
Yeah.
and some others. But the point is that's not ending. You're right. I mean, the relocation is continuing for all the lots of
Yeah.
reasons. And so, yes, so I mean, the demand is going to be constant, and as we've seen, really, I mean, for years, but the people coming from those places still think we're cheap relative to where they're coming from, right? I
Yeah.
mean, especially the California people. But so yeah, that definitely adds more I don't know, upward trajectory to pricing when
Well,
people are coming from out of town and from expensive places.
Well, and I think that's something that we just have to continue, again, educate our clients, especially our buyers, and that certain markets that are really still at the top of the list, Collin County be one of them. You might have to go a little bit more into a tertiary market in our DFW. And I don't mean tertiary outside of DFW, but if somebody wants to live in Frisco, you might need to push into Aubrey, and doing different things like that. So buyers still have choices. I've got first-time home buyers under contract right now, that didn't have as much buying power, and still got great deals. I mean, I have one that VA loan, we were able to negotiate all their closing costs to be paid. I negotiated another $5,000 in furniture. There were several other things that we were able to do, and they're actually going to get a refund check at the closing table. I mean, after the money they paid up front. So there are deals still to be had, but we have to be educating our clients where they have a little bit more power in the marketplace and where they're going to be paying a premium. So I know Patricia, yes, so she had said on one point, she asked how common are assumables if we're going back to the rates. I know that's something that is on the residential side. I don't think that that's as common as we're seeing in commercial debt services and things of that nature.
I'm not the expert in that, although, from what I recall, there was is it FHA or VA that had one of those had some assumability, but most of the other, most of your conformings and most of your jumbos or whatever all have the due on sale clause that basically prevents the assumption of the debt. So that's made it a whole lot more difficult than, it was way back before they inserted those due on sale clauses.
But and to kind of piggyback on another question of Patricia, it's where if somebody sells, where do they go? And I think that's always a concern. That's been a concern for the last 2.5 years. Is great.
At least, yeah,
I can make great money on my home, but where am I going to go? And I think what unfortunately some sellers, if they're in a position that they have to sell to protect themselves, to put a little bit more cash into savings, those type of things. I have a seller right now that's doing that very thing. And so, they're going to rent for a little bit, and then they're going to make sure that they maintain their level of savings and just get back on their feet because one spouse lost their job. And then they're going to re-enter the marketplace because they know the best thing to do is still to invest in hard assets and real estate. And they'll do that when they feel more comfortable because their risk tolerance is a lot lower to ride this out. So they'd rather be on the front end and make a decision.
Where do you go though is it's a real issue and really has been for, like I said, even since the great financial crisis, because we've been pretty tight, since, I don't know, at least 2014, 2015 to where, all of a sudden the inventory got super tight and because home builders weren't building in as much. And so anyway, no, that's a real issue. And, but as Ashley said, I think one of the things, sort of a mantra, so to speak, that I just keep in my head is that politicians, and you could say the Fed too, but are generally going to try to take the easy answer, and they like their jobs a lot, right? And so fighting inflation and doing these things is hard. And not spending a bunch of money, to give to your constituents is hard. And so, when in doubt, assume they're not going to make the hard decisions unless they have to, right? And so if that is the something that you also agree with, then that means we're probably going to have inflation for a while. I just don't think we're going to tame this inflation dragon. And so if that's the case, then absolutely, you've said it a couple times here, but you would much rather have hard assets, like a house, or, or barrel of oil, or a piece of land, or a bar of
Bricks
gold,
of
or whatever it
gold.
is. Yeah, no,
Yeah.
that's the whole argument for Bitcoin. Now, I'm not a Bitcoin person, but the whole point is financial assets just get creamed when you have
Yeah.
inflation. And
Yeah.
I certainly don't want to be out of the market if I don't have to be, but as you said, some people are going to have to sell a house. There's going to be some forced sales, whether, risk tolerance or job loss,
Yeah.
or, but in general, to me, that's one of the encouraging things, I guess. Somebody was asking about pricing earlier. And, I think the store of value in the dirt is something that, I take comfort in, because I don't take comfort in the way, our leaders,
Or asset
are looking at,
managing our
yeah,
money.
exactly.
Poor asset managers, I tell you.
This inflation is, it's brutal. And, I don't know that we're going back to 2%, even though I know that's the target.
Well, and here's the deal. And I know there's a lot of conversation about short sales and foreclosures. That's only for the people that don't want to proactively seek out realtors to help them understand what their options are. There's still going to be people that just turn their blinders on and unfortunately allow things to happen to them. But there's a reason why during COVID, and the last year alone, the foreclosure rates and the short sale rates are absolutely low.
Minuscule. Yeah.
They're minuscule. And I don't believe that doesn't mean you don't educate yourself on what to do if somebody has that situation happen to them. But at the same time, I just don't think that's going to be the lion's share of the marketplace, as a buyer's agent or a listing agent. But always education is always key in those situations. But I think the biggest thing is with sellers that are having to sell, maybe they're selling their dream home, or maybe they're selling their home that they absolutely were really happy in. And unfortunately, to cash it on the equity and to go buy something else means they have to step down. And so a lot of times it's a pride situation. And I'm not saying that it's not real. I'm just saying that you have to still encourage them, because somebody else did say that rents are just as high as mortgages. And that really is the fact. And so that means maybe
it is, but you can also get your cash out and pay, whatever, if whatever creditor is knocking at the door,
Yeah.
So, again, it's going to happen, and again, I don't mean foreclosures I just don't see a huge number of foreclosures, but it's the same idea. It's just, you can walk away with some cash in your pocket and pay bills and live on, the equity that you take out of a house that you're selling. And so it's a forced sale in that you need the money, and to get back on your feet. But unfortunately, I do think that's going to happen. Just when we do have a economic slowdown, job losses will inevitably. That's how that goes, right? You have some people who just have to do that.
Yeah. Letitia asked if the house I recently sold for over ask, purchased by an investor. I would say I might have had 2 or 3 investor offers, but I would say the majority were primary occupants. I had, I think a handful of cash offers, and then the rest of them were owner occupant, financing deals. And so we went, that's what it was. And that made me feel a little bit better that it wasn't a financial decision. It was a decision to make it a homestead. But, I think what we can do is continue to share stories and data. I've got another one coming up in Allen at the end of this month. And so we've been working readily to get that one market ready. And it'll be interesting to see, in a 3-week period, if things change, because, Allen is obviously still a hotbed, and kind of look at that. So I think we just have to pay attention to the market trends. What's going on with the buyers and the offers is the best way to kind of inform our sellers of how the market is doing and what that is bearing on that side. So, and I went to the IMN conference today, which is actually a multifamily networking conference. And so it was interesting to see from that end, they were talking around the same conversations. And they were talking about distressed sales, but they were talking about it. They're only distressed sales because of defunct partnerships. And so partnerships, because through stressful times and the uncertainty and everything else, Unfortunately, then unfortunately, that's where assets are coming on the play. But they just talked about, again, even in, 10, 20, $50 million projects, they said ultimately there's just too much capital, pent-up capital in the marketplace in these hotbed areas to really see favorable deals. And even if there's a seller that has a more realistic expectation on the list price, well, that's just driving the buyer appetite up. So if the seller starts at that top end value, it doesn't matter. They were just like, it is
get there either way. Yeah.
They're going to get there either way. And so the correlation between the two is still relational, to sit there and say, that's what we're dealing with, because there's too much capital. And I will tell you, what the other interesting part, it was the fact that on those houses, majority were first-time home buyers. And it's crazy that 600,000 is a first.
I was about to say 600.
600,000 is a first-time home buyers market. But when you think about that, I think the average age of the person, a decade ago buying their first home was 24. And now I think it's something like 34. And so when you talk about getting into more of your peak earning potential times, they've had the ability to save, do all of those other things. I think that's changing the landscape too. And so they have bigger down payments. They're able to afford the larger mortgages. So I just think it's interesting all around. So pay attention to what's going on. And I know the rate of our product appreciating here is unsettling for a lot of people. But like you said, people coming from other areas of the country, they're still seeing us fat and happy and plenty of meat on the bone for them.
Well, and I've said this for now, probably 9 months, but we certainly have slowed down in real estate in North Texas over the past 9 months, right? I mean, I think prices are a little softer than they were in general, say in June of 22. I think that's considered the recent peak. And I think the way we think about that, really, we need to sort of recalibrate our thoughts, because sort of like we all got used to day one, multiple offers. And I know it's partly even here again, but like, that isn't a normal market. And realistically, it's not even really the healthiest market. Like a healthier market allows people to actually, walk through a home before making an offer, for example, as opposed to having the buyer agent do a FaceTime. Yeah, exactly. And so I think, I mean, again, I know we're sitting here and saying, oh my gosh, our price is going to soften it all. Oh my gosh, our seller's going to have to sell, and are there going to be fewer buyers? If we get back to 4 or 5 months of inventory, and prices don't go up, for 5 years, I'm just making up an extreme example, we would be actually in a healthier market than what we've seen the last 3 years. Like it's been so tight that buyers have had to do crazy things, So anyway, I know I've sort of have some negativity about, oh, we've got inflation, and oh, some banks have had problems, and oh, this, that, and the other. But I mean, I think the reality is that we've all gotten used to this overly tight market that ultimately it needs to loosen up for the health of the market. And to, if anybody on here is a buyer's agent, they're the ones nodding their head, right? If they work exclusively with buyers, they're going, amen. We need some sanity, because it's been insane now for, pushing 3 years.
But here's the deal. The funny part was, we were saying that for a while, weren't we, Britt? We wanted to recalibrate and be healthy and all these other things. And the minute it did, we're like, what's going on?
Yeah, exactly.
The sky is falling.
Yeah. It's easy to say until our oxes are being gored or whatever.
No. And you know what? That's the biggest thing. And here's what I will tell you about that house in Plano. And I use that example because it's the most recent one, and it's relevant to, it was right after SVB and all of these other things. But the difference was too, there were things, we got that house market ready, but there were still things that needed to be taken care of. All the windows needed to be replaced. The cabinets in the kitchen were original, but they'd been repainted. There were certain things that an average buyer might want to do at a different time. And so we had a very constructive conversation with my seller and just said, I think we need to price conservatively, because buyer temperament has changed. and because the buyer power has changed as well, we need to make sure that we position ourselves to where somebody's excited, even though there are things that still need to be done, that they're excited because everything else in the home is so beautiful, and we staged it and all these. I actually got calls asking if it was virtually staged. And that's something that I will tell you right now,
Wow.
listing agents, and I staged it myself, lost a lot of sleep over it. But that's important because everybody kept on calling saying, my clients want to make an offer. They haven't even seen it. And I encouraged everybody to don't send me an offer sight unseen, but they said the photos were beautiful. And so just continue to encourage that, because NAR just came out with a study. I think it's 98% of buyers purchase the home online mentally before they even go to see it. They're only confirming that they still want it by actually going to a live showing. So that's super important. But we worked really hard to overcome some of the objections. And that truly is why, because it appraised. We already have the appraisal back. It appraised for the 6.25. So even though we got 50 over asking, buyers said, no, the market value is actually 6.25. And
well, if you had four offers at that point, I would argue that's a pretty good appraisal then.
100%. But what we did was, it was the psychology of it, was let's still keep people excited and feel like I have room now to make some of these improvements, but I still feel like it's worth this. But we still had an inspection. We still negotiated, a considerable amount of repairs and had no problem doing that because they made a fair offer. There were still things that gave us a better even playing field, even though it was much higher. But these buyers aren't coming out of pocket any additional money over their original down payment because it appraised. And so that is what I would call a true win-win in that scenario for both parties. So I think just continue to have those conversations with people, and buyers will feel like they're getting the home that they deserve and that they want, and sellers will feel like they're being made whole on the other side as well. Yes, Patricia, people can afford the cost of the home, but the taxes send them down to a lower price bracket. So this is a good segue for me real quick, because tomorrow I got to figure out how I can disengage my brain and go to bed early tonight, because I will be getting up at 4:00 in the morning to go to Realtor Day at the Capitol tomorrow. Our buses leave at, I think, 5:30 in the morning. And there's about 2,000 realtors that will be ascending upon the Capitol to have meetings with legislators, both of the House and the Senate. We have a lot of real estate oriented bills that are coming out of committee right now, a lot of housing bills in regards to taxes, Patricia, and affordability on that. So that is something that is of grave concern. So two things I'm going to mention there: get involved, educate yourself, tell your sphere to vote. Get involved at the association level if you want to get more plugged into regards to what that advocacy piece looks like and understanding that. Because I know they all like to say it, if you're don't have a seat at the table, then you're on the menu. And that really has been what's been going on for quite some. I know I hate all of those isms, Britt.
It cracks me up though. Still
yeah, no, but it truly is, because what we do is get to share our stories with the legislators and our representatives, and we get to tell them these personal stories about people getting taxed out of their homes, erroneous overreach by local municipalities, construction fees, different things that are providing friction between providing quality product and then the end user being able to appreciate that. And so we're still fighting those. There's a lot of HOA bills that are still getting filed, property taxes.
Well, the whole new one this year is they've got this surplus that they really have never had before, where they got to figure out what to do with it. And property taxes seem to be a big focus on potentially how to give back in a way some of that. And so clearly the advocacy of agents like you and your tree pack dollars and all that, I think is important for getting those things decided.
Well, and I think that's what we need to understand, is the fact that we have better options than just allowing these market nuances to happen to us. And so, but you have to get involved, guys. You can't be flat-footed and complain about what's happening. You have to go, where can my voice be heard? And that doesn't mean you have to be on the front line. It just means you have to support different initiatives. So you don't have to get up at 4:00 in the morning and be a glutton for punishment like me and go directly to the Capitol, but I'll be having one-on-one meetings with other realtor members and lobbyists to sit there and talk about the different things that are plaguing the North Texas market and the average homeowner across the board. And so get involved at your association. MetroTex is a great segue into that, whether it's committee work or getting involved on the advocacy portion. Feel free to reach out to me personally. I've plugged a lot of people in from talking about it on Real Talk into different avenues that they're passionate about. And the byproduct is then you become the market expert and then are able to articulate that to your clients. And I can't tell you how many deals I've won over and clients I've won over because I know what's coming down the pike, and I'm able to help them be more agile and not flat-footed to protect their assets. Patricia, reach out to me via Facebook after this and I'll get you plugged in. But those are the things that we can do, is to continue to have the conversations like we are today. Maybe we won't all understand the impact of the Fed rate hikes and the banks failing and all of those things in the same capacity.
Some of us just know the theory and we'll see what the real practice is, because sometimes those deviate as well. But yeah, no, it's interesting times. And I know we laughed about whether, there still is a bank issue or not. I don't think the bank issue is behind us. Now, I don't think that means that every bank is going to fail or anything like that. But I think that's something we're going to also be monitoring, speaking of things to monitor, because like my analogy earlier of water on your roof, finding the weak spot and seeping in. Well, they already, they've dealt now with the Silicon Valley Bank weak spot. Where's the next one? And there's going to be one, just because a lot of these regional banks did the same thing as, on their asset side, buying a lot of bonds. So they're underwater on their assets that they own. Now, the good news is that they don't have the deposit base who is significantly over the 250,000, with, like I said, that's where Silicon Valley Bank was so different, or one of the ways. So, but I do think that, we're still seeing this, First Republic Bank out of California, a lot of rumblings there. And, then all the sort of regional banks. And we haven't even talked about, sort of the next shoe to drop is if some of these commercial real estate loans that are owned generally by smaller banks, like if you own an office building or lent the money on an office building in downtown San Francisco, like you're in trouble. Like you are going to lose value on that loan, just because office space in San Francisco, office space everywhere is difficult. And then certain places, have become, like San Francisco specifically, has become kind of a zombie city in more ways than one, maybe. But but anyway, so I think that's going to be the sort of next shoe, or the bank vigilantes who are out there looking for trouble. That's what they're pouring through next, is who's got exposure to commercial real estate. Let's go attack them, And so anyway, I think that they're still in for a rough patch, and, keeping in mind, depositors need to keep in mind the $250,000 FDIC insurance limit if that impacts you, because like I said, the federal government has not said that they are going to definitively expand the FDIC insurance coverage. They've kind of implied that they might, but anyway, that's not something that's completely behind us. So just be cognizant of that in your daily travails.
Yes, I think that's the biggest thing, is stay informed. And if you don't know the answer, that's okay, but seek out other individuals that do and are willing to share that knowledge and kind of give you the nuts and the bolts without the emotion of it. And just, that's the best way that we can protect ourselves and protect our clients, is just to continue to stay informed. Don't fall victim to clickbait, even though some thought our headline today was, even though that was just a direct correlation in trying, because that's what people are talking about. And so you want people to consume good information, and sometimes you have to use a tantalizing title to get them to tune in. So, that's what we did this evening. But at the same time, I think by all the comments and the thank yous and everything else, it just shows that, we're going to continue to provide value. Britt and his team at Fair Texas Title are great resources, not just for title services, but for information. And then You know what, Alroy? Yes, we will do a recap on a Real Talk for my trip to Austin. I think that would be a great one, and we'll discuss that in the future. But this platform allows us to be agile and in real time bring real issues to you guys. And I know I said real multiple times,
talk.
Real talk, but
Yes.
that's the whole point. We don't. I try it, which is a lot of stress. We don't slate this months in advance. In fact, Britt was happy to come on. I think we asked him 2 weeks ago, and he said, "Let's do it," because we knew that this was something even before the banks that we needed to discuss the inflationary market and the Fed rate hikes and everything else. And so we'll continue to do that. So, subscribe to the YouTube channel, like the Facebook page, because it will inform you as to more things that are going on. But we are right at 6:30, but at the same time, Britt, oh, look at that. You got a thanks, Britt, from Sherry.
Oh, I thought she was calling me Pickle.
No, that's my name.
That's you. Okay.
Yeah, good job, Pickle. So, for me, she's called me Pickle. That's my mom, everyone, who is my business partner. She's chair of forms and contracts and an esteemed colleague in the real estate industry. But she called me Pickle my whole life because sometimes I'm sweet and sometimes I'm sour. So that's where
I like it
from. But,
Sherry, brilliant. I like it.
But Britt, what do you want to leave us with tonight with our viewers?
Well, I mean, I think don't worry about the provocative headlines. Like I said, there's going to be a lot of transactions to have. It's just we're always going to be rolling with the punches, so to speak, and so there will be some negative news inevitably, whether it's more inflation like we're currently dealing with, or recession, or banks, or whatever. But I mean, the point is, people are still going to be buying and selling houses and needing good guidance from their real estate professionals. And just as a plug, they're also going to need really good title people in that. So we would love to help you at Fair Texas Title. We're all across DFW. So that's about the best words of wisdom I can give.
Yeah. And again, guys, align yourself with good affiliate partners, because sometimes we feel like we're on an island as independent practitioners. And we're all getting hit in the face physically and metaphorically sometimes with a lot of things, but being able to pick up the phone and call my trusted partners and saying, hey, kind of walk me through this, whether it's lending or title, even just construction. I mean, there's a lot of inflationary impacts that are still plaguing the construction industry, and understanding what that means, because proper expectation set can usually help you pivot around other things that are happening. So be proactive, seek out the information, get involved in your local association, whether it's Metrotex or anywhere else. We would love to have you. There's tons of value add opportunities. Tammy, you are great as well. She said, Britt always has great information to share, and it's my honor to host this. So, we will be here. We will do a recap on the Hill visit. And we'll have Britt back very soon. And in fact, I think when's the next after tomorrow? Was it May 5th or something that they'll do?
As far as the FOMC?
Yeah.
I think it's every 6 weeks. So that's probably about right. So,
okay. So maybe we'll try to have Britt back sometime in May.
Hey, we can have, if I don't even know what the day, but that's Cinco de Mayo by definition. So therefore, that would be perfect for this.
Cinco de Mayo.
We'd have to have margaritas and sombreros and all that stuff.
Yes. Well, on that note, that's the best segue to say, go have a drink yourselves, folks. This was a great evening with a lot of dialogue. Britt, we appreciate you for being.
Thank you for having me, as always.
A great partner for Metrotex, a great partner for Red Branch Realty as well. And you know what? We'll talk to you guys soon. Have a good evening.